evidence that the labor market is weakening. I think they will cut, but they're not going to cut preemptively based upon a forecast it might happen.
I see instabilities out there, Dr. Clarida.
Many of them.
Turn to Richard Clarida in the Financial Times, taking us back 40 years to Plaza and Louvre.
Yeah.
I've got EM currencies moving.
Yeah.
Some of them are moving 4 standard deviations. Do we, and particularly does President Trump not understand that his tweets can shatter the financial system?
Well, I'm not sure about that. I will say that, coming into the year, there was some commentary, including by now CEA Chair Mirren from his work of last year, which was sort of dangling the idea of let's weaken the dollar, let's do other things in the Treasury market. And I thought that was a risky move. And I've noted since then, including at the IMF meetings recently, he's sort of walked that back. And Scott Bessent, including when he's on Bloomberg, says he's in favor of a strong dollar. So maybe they're trying to put that genie in the bottle.
As a student of this history, do we underestimate the potential shocks that are out there? Are we all too complacent, except for John Farrow?
Well, I would hope we're not complacent, but yes, the world economy has operated for 40, 50 years in a particular regime, a dominant dollar, more or less credible U.S. monetary policy and innovation and all of the rest. And, regimes don't necessarily last forever. So I think there is that risk. I don't think it's front and center right now, but I think there is a risk, sure.
Bob, you've had a second to digest all of the headlines as they've come out. Did anything stand out to you as noteworthy or telegraphing how they're going to deal with this dilemma?
Oh, they did put in the risk of higher inflation and higher unemployment have risen. So they've taken a pass on having to determine which of the two they place greater value on. And I guess, Rich, I have a question for you. You've been at the table with this. We know 4% core personal consumption expenditures are 2% away from their target. What's 2% away from their unemployment target?
Well, I think right now we're in an environment where I think they've telegraphed, and I believe them, that any appreciable move, 0.5 point, 1 point in the unemployment rate is going to get them off, and the dime and start cutting rates. And so I don't think you need to calibrate, and they're probably not calibrating it too carefully beyond that. And it is a risk. I think, as we've all said, there's a two-sided risk because we've had 4 years, including one in which I was there, in which inflation was not transitory. It was above target. This could be the 5th year in a row. And I think that's why they're looking at inflation expectations.
Equity markets rolling over this afternoon. As Lisa pointed out, bond yields are lower. We're down by 4 basis points on the 10-year, 4.26. When they last met, March 19th, at the close, 4.24, almost bang in line with where we were a number of months ago. But a lot has changed, which is why this line pops up in the statement. If you're just joining us, no change to policy expected, but some new language here. The committee.
$97 premium, $20 were my fees, $118. Now, I covered up my private.
And higher inflation have risen. Mike McKee, I want to bring you back in before you run off to this news conference. Mike, as you know, those comments at the Economic Club of Chicago a number of weeks ago maybe irked this White House and the President of the United States. What are you expecting to hear later on this afternoon?
Well, I would imagine now that it's in the statement that Jay Powell will stand behind it. And of course, it's what he said in Chicago. Now, the question is, how is the president going to react to this? Because he was upset about the Chicago version of this that came right after Liberation Day. But the Fed otherwise doesn't mention the administration or the White House, except to say that imports affected GDP. So is this a poke at the White House, or is this just accepting reality and trying to get the markets to accept it?
Mike McKee with the latest. Mike, I know you've got to run. Mike McKee heading into that news conference. The news conference, by the way, starts in about 23 minutes' time. Bob, your view on what's happened with central banks elsewhere? The ECB cut interest rates. This president was annoyed by that. Overnight, the Chinese central bank cut interest rates. I imagine this president is annoyed by that. They look at the same policy shock but see a different outcome. Abroad, they believe this is a disinflationary, potentially deflationary shock for Europe. What kind of shock is it for this Federal Reserve?
Well, I think for this Federal Reserve, they're worried about the stagflationary shock. They're worried about exactly what they talked about, which is inflation goes up 4% or higher, Unemployment goes up, closing in on 5%. Now both are kind of at a similar break-even level. What are you supposed to do? I'm in Rich's camp. I think you've got to save the economy, because if you don't save the economy, then you've lost on both mandates.
You live some of this, Rich. I just wonder how you'd live it right now. It's so public, the criticism of the Federal Reserve. As a committee, when you heard these kind of things, you saw the social media posts when you were on the committee.
Oh my, yeah.
How did you deal with them?
Well, after a while, you sort of get used to it. And what I would note is that there was some criticism of the Fed when we hiked rates in December 2018. And then there was criticism of the Fed when we cut rates in July of 2019. So at some point, you put your head down, you do your job. And of course, the mandate is price stability and maximum employment. And so that's the way I thought about it and the way we thought about it.
Rich, what do you make of the fact that they dismissed the first negative real GDP print in a long time, in years, as simply swings in net exports? Some people would say that's accurate, but the fact that they led off this statement with that really highlights how much they are shrugging off the negative economic indicators that are glaring.
Interesting observation. I think there were good economic reasons to shrug it off. I mean, the surge in imports and probably some measurement issues. And I had been thinking and been saying I thought they would shrug it off if it came in negative.
It's really the media.
That said, it was interesting that they did choose to lead off with that observation. I think that is another way of them saying they think they're in a good place. They'll wait and see. Had they emphasized the negative print, it might have been more difficult to justify what they want to do.
You'll notice this equity market has taken another leg lower. We're down about 4%, 4% of 1% on the S&P. Don't get too excited on the S&P. It's not that exciting this afternoon. Let's talk about the why. We've got some conflicting information. At the same time, the Federal Reserve is saying growth potentially could be weaker, unemployment could be higher. They're also facing down the prospect of higher inflation as well. The President of the United States is not backing away from the tariffs from China too. You combine those two stories, you've got a weaker backdrop for risk going into this news conference.
This is the worst of all worlds, especially given the fact that Fed Chair Jay Powell is not going to do what a lot of people thought he would do, which is to come out and say, we're very concerned, we're going to cut rates, don't worry, we got your back. No one thought he was going to say that, but some people were hoping that maybe he would, including somebody at the White House. To me, this represents the dual shock that the Fed cannot address. And to me, that is the key question. What other tools are at their disposal, and how are they watching market functioning as a virtue of that 10-year and 30-year yield at a time of some potentially messy options?
Still on that, to extend the conversation, Diane Swank of KPMG joins us now for more. Diane, welcome back to the program. I remember when we were talking last time around on March 19th, you and I were both in agreement. We looked at the S&P, we saw a weaker forecast for growth and no move to the median dot. We both said this is hawkish. This is a Federal Reserve whose easing bias might be constrained. Dan, do you think they're communicating that a little bit more clearly, even more clearly, in today's statement?
I do, and I guess I disagree a little bit with Rich, and I know he's at the table, but I think back to that 2022 Jackson Hole, Wyoming speech, which was like the there will be pain speech. The bucket of ice dropped on our heads when the Fed was put in a situation where they had to worry about inflation over unemployment, and they thought a recession may ensue. Luckily, it didn't. They were willing to make that decision to go ahead and raise rates anyways because they were behind the curve and still catching up at that point in time. And I think they're still smarting from that period. I also think it's important. I was in Chicago when Jay Powell spoke, and he made an important point in the Q&A, and that is that no matter what, the bump in inflation due to tariffs would be temporary. That means that they hold off a bit before, as unemployment rises, or we get some red ink on unemployment, and then they cut. It is not only not preemptive, they have to wait in order to make sure that inflation is coming back down again in the fourth quarter.
Rich, in preparation for this meeting, I was reading the economist Oscar Wilde, and he said,
every time a member trades or passes a check with what you've been doing,
we've all got answers. We've all got analysis.
I think we probably are.
Got our monetary textbooks out. We're reading Mankiw. Guess what? What's the unexpected out there?
Wow, so I guess we're into known unknowns and unknown unknowns.
I guess to me, the
unexpected would be if Mike McKee or someone asked Jay Powell today how they would respond to a rise in the unemployment rate if he repeated what he did at Jackson Hole 3 years ago, which is some pain, inflation's too damn high. So that would be the unexpected at this press conference.
What does pain look like? Rich, what is pain? Because quite clearly, if I lost my job, that's painful for me.
Yeah.
If the three of us lose our jobs, I hope it's painful for you. You'd miss out on a lot, I'm sure. I want to understand when it becomes painful for the Federal Reserve. What kind of number is painful for the Fed?
I think I put it out a moment ago. I think round numbers, I think certainly if we got a 1 point rise in the unemployment rate, I think probably even a ½ point rise in the unemployment rate in the context of a cracking payroll employment report would be enough. I think probably the only person who knows for sure is probably Jay Powell, so I'm just guessing, but to put round numbers on it. Yeah.
Diane, what's your view of this in terms of the pain that would get the Fed's attention at a time where, as Rich has put out, there has been elevated inflation for years above where the Fed has targeted?
Well, and I actually agree with Rich on the degree of which we'd see the unemployment rate go up that would precipitate the Fed to feel comfortable that it could begin cutting because the demand is so weak that inflation will come down. But that is after the fact of inflation actually going up. And remember, unemployment is a lagging indicator, and I think that's important. We also have one other factor out there that we've yet to see fully influence the labor market, and that is whether or not the change in immigration policy results in lower labor supply, which was part of the soft landing scenario, but it also will mean a slower increase in the unemployment rate if we lose the participation of those foreign-born workers. So all of those things together leave us with a period of the economy with maybe red ink in payrolls before the Fed actually cuts. And I think that is the important message. The timing is only maybe a few months apart, but that not preemptive, but also not synchronous, I think is what we have to walk away from.
About Michael, one of the arch things here is Michael Feroli's thoughts from years ago about such a low potential GDP number. Maybe we got saved by productivity, who knows, maybe it was triple stimulus in that. But in your framework of the debt market, around Clarida's economics, do you just frame in a new lower GDP that we have to get used to?
No, I don't think so. And I think if you talk to Mike Feroli today, he would tell you that the post-GFC environment has faded. There's a new generation that's in place, call it loosely the millennials. There will be a demand in costs and productive use of capital. So we're going back to an environment that existed pre-GFC. I think what's interesting to me right now is the markets have voted. And if the FOMC is going to tell them that that the risks are higher unemployment and higher inflation, neither of those are good. So equity prices are down, bond prices are up. At least we've got sort of right-way correlation today.
John, have we heard from President Trump yet?
Not yet, not on the Federal Reserve directly, Lisa, but I think he's shaken up this market already.
I was going to say that the fact that he said he was unwilling to lower tariffs to get China to the table is a pretty big headline that maybe is getting more of the attention in markets than elsewhere. But Rich, to Bob's point, and this is a good one, and it's one that actually Treasury Secretary Scott Bessent made just a couple of days ago, the two-year yield is screaming that the Fed should have already cut rates. Do you buy that type of reasoning that this market is pricing in a slowdown that the Fed should preemptively respond to?
The market is pricing in a material probability of a recession, and Secretary Bessent's entitled to say then the Fed should cut. I think what we're hearing and what we'll hear today is that's a risk that they're willing to take given the history of inflation and given what they see down the pipe. So the markets are pricing in 40, 50% chance of recession. And as you pointed out 5 minutes ago, the past 30 years, the Fed typically already by now would be in preemptive mode to ride to the rescue. But again, history is relevant here, and that's why this time is going to be a little bit different.
To us more directly, though, what do you make of the specific argument that the Treasury Secretary is pushing? The idea that the two-year yield is trading below where Fed funds is, and he believes that's a sign potentially that the Fed's too tight and the market's telling them to cut. Is that a good measure of things?
It's a sign that the probability of recession has gone up, and that in that scenario, we all think the Fed will be cutting. The difference is that I don't think, anyway, that the Fed's going to be cutting to try to get ahead of that curve. As Diane said, the very real risk is that they're going to be late, and certainly not early.
Diane, based on that, how much has the risk of recession gone up just in the past couple of days, given the fact that it seems like the Fed is going to reiterate that point?
Well, our view has been the risk is 60% for some time now, and I would bet that poly markets are probably back up to 60%. They had come down just a little below that in recent weeks with hopes of more toned down rhetoric with regard to trade tensions, and now that's being unwound today. I think the risk, what the Fed has to do, and Rich knows this as well as anyone, and what we're doing, and it's a lot more work, is probability and scenario analysis. Yeah. That's all we can do. We put on a certain probability on what tariffs will be in different kinds of regimes and how they're likely to play out, and and sit down and think about how would the Fed, stepping in their shoes, have to react to all those scenarios. So our recession scenario is 60% probability.
The companies are doing the same thing. Diane, just before you run, that news conference starts in just a moment. Your number one question for Chairman Powell at the moment, what is it?
Well, again, it gets down to how much pain are you willing to endure before you feel you need to cut? And that's, Rich has answered it. It would be nice if Jay Powell answered it. I don't think he will, but it is one that we all need to know is, what is the pain threshold and the trade-off for the Fed, and how late are they willing to be?
Diane, thank you. Appreciate it as always. Diane Swonk there at KPMG. We've had the decision from the Federal Reserve. No change to policy. The news conference starts in about 11 minutes time. This stood out at the statement. If you've not read it yet and you're just joining the program, welcome. This stands out. The committee is attentive to the risk to both sides of the dual mandate, and judges that the risk of higher unemployment and higher inflation have risen. To discuss, Matt Lazzetti at Deutsche Bank joins us now for more. Matt, welcome to the program. Is that your assessment of things as well? Do you share that view of the FOMC?
Yeah, I think no doubt. If you look back relative to March, uncertainty has clearly risen. We've gotten tariff effects and tariff announcements that were substantially larger than anticipated. Downside growth risks to the economy have clearly risen. Upside risks to the unemployment rate, inflation risks are clearly higher. So I don't think anybody would really debate at the moment that risks are far more elevated today than I think that they were back in March. And from a stagflationary perspective, that inflation is likely to be higher and the unemployment rate is likely to be higher.
It seems like there's a bias right now in markets, Matt, that the unemployment rising feature of this dual mandate is actually more important than the inflation side of the mandate. And that if unemployment rises enough, the Fed will respond to that even if inflation is still elevated. Do you think that needs to be pushed back on, that maybe that's not the bias that should be there?
Look, I think that's right to be the bias. The question is always kind of thresholds for which the unemployment rate needs to rise to get the Fed to act. And there, I do think that the market may just be anticipating that the threshold is lower than what the Fed is actually willing to deliver on. At the same time, I think you do have healthy dynamics. I mean, we got a better ISM report, ISM services. You had a jobs report that surprised the upside. With that, we've substantially taken down the probability of cutting rates by June.
Good.
Now, a lot of that's getting priced out to later meetings. But if I were the Fed, I wouldn't be too perturbed by market pricing at the moment. They probably agree that recession risk is elevated. And we'll just kind of have to see how that plays out. I think importantly for them, the market is responding to stronger data by reducing near-term rate cut probabilities.
Matt Lazzetti, David Folkerts Landau got it right. He said there would be a new Europe, there would be a new investment in Europe, maybe a new nominal GDP, a higher pulse, if you will, for Europe. That's one of the unexpecteds here. What's the unexpected you're looking for that we're not talking about?
Look, I liked Rich's unexpected, which is that Chair Powell highlights that we're willing to take pain here. I don't really anticipate that we get that. I think near-term unexpected would be if he kind of gives clarity that they're still in no rush to cut rates. Essentially says that June is probably off the table. I think at the moment the Fed is likely to just take a step back, not provide much forward guidance, let things play out as they come. But I think importantly for them is going to get clarity on two things: trade, but also fiscal policy. Because I think if fiscal policy and tax cuts are larger than anticipated, then this turns into something that looks kind of like a mini COVID shock. You have a big supply side shock from tariffs, immigration being coupled with a demand side stimulus from tax cuts. And I think the Fed will really want to see both sides of those policy decisions.
You're fired up about this, but take it internationally. Take it to the stimulus in Europe, to a higher nominal GDP, the true unknowns we don't understand about a China fiscal policy and the mess that's in Washington.
I guess on both those time, I'm even though I grew up in Illinois, I'm from Missouri on those. I mean, the Europeans have talked for decades about this. We get it, more demand growth, more fiscal space. The Germans maybe will pull it off. What I'm hearing from my colleagues in Europe is it's not clear the rest of Europe is going to do that. Again, the same with China. I mean, we've been talking about boosting consumption, being less reliant on exports in China for 25 years.
And you're still showing me.
So I'll believe it when I see it.
When you say Missouri, our international audience has no clue what you're talking about.
Can I just say I appreciate the healthy skepticism regarding Europe? Because it's kind of been ridiculous, hasn't it, over the last several months? Well, Europe's the place to be. They've got their act together. Germany might actually do some stimulus, sure. Is the rest of Europe going to follow? How constrained are these other nations?
Yeah, and let's see how long it takes for Germany to get it.
First of all, I didn't even know what news station I was on. I think this is Bloomberg. I never watched Bloomberg. I just flipped it on, right? But I'm just here watching, looking at the charts, actually doing some trading, seeing how this market moves. So I'm going to jump back off the screen, and we'll get back into it right here.
That in the near term, you're going to see elevated inflation. The pain threshold for the Fed is going to be elevated because of that. I kind of think as they begin to see unemployment rates that are 4.5% or 4.6%, then it becomes a greater debate about cutting rates to respond to the downside risks of the economy versus the elevated inflation, which certainly is a concern for them. You know, if inflation expectations pick up, I think that could be pushed out further into the future, but I would view the risks as them cutting a bit earlier, certainly if we get downside realizations on the economy with the unemployment rate rising faster.
Hey, Matt, thank you. Matt Lazzetti, Deutsche Bank. One cup, December. You can drive a truck through the range of estimates on Wall Street right now.
Yes.
Forget market pricing. That's just averaging out a wide range, an incredibly wide range of outcomes. I've got Morgan Stanley and Mike Gapin at 0 for 2025. And on the other side, Andrew Honhorst of Citi at 125. For 2025. That's a very different view of the world going forward from here.
A real lot of it has to hinge on when the hard data rolls over.
Yeah.
How long does it take? Because that is going to be the whites of the eyes that the Fed will respond to.
That's 5 Fed meetings away. Think of the drama we could have.
Could be a lot of drama. Do you want some good news? Take a look at the market screen. Equities roll over, down 0.25% on the S&P. Look what happened to bonds. Bonds actually rallied. Bob Michael, music to your ears. Bonds are doing what bonds are meant to do. Do you take some comfort in this move?
Yeah, and that's what we're hearing from our clients. They felt that they were underallocated to fixed income. They've been coming into the markets. They're a combination of institutions buying taxables, foreign official institutions buying treasuries, and actually individual investors coming into the municipal bond market. So I think we're going to continue to see a lot of flow across bond markets.
This is something that clearly Treasury Secretary Scott Bessent has been looking at very closely. He talked extensively about this today. He's even looking at the auctions and the dealer take-up of potential auctions. I'm just wondering what would get you nervous and how much can the Fed respond with bond buying? How much their balance sheet potentially is going to be on the table later this year, especially as they become politically enmeshed in the fiscal aspects?
I'd get worried if both ends of the Fed's mandate got pulled to extreme levels. So core personal consumption expenditures up over 4% and unemployment up close to 5%, and they still feel they can't do anything. Then I would start to worry.
Dr. Clarida, what would you do with the dots right now?
Well,
using visible ink?
Today there are no dots. You know, I think at the last press conference, Chair Powell said, I'm paraphrasing, said something along the lines of, we had to write down something.
Exactly.
I mean, you know, as a student of the dots and then as a dot writer for 4 years, I've observed under all Fed chairs, Bernanke, Yellen, and Powell since the dots, there's some meetings when the dots tell the story they want to tell and then they embrace them. There are other meetings when the dots, you got to write something down. So I think I would be in the you got to write something down mode right now.
I think a lot.
Unmute. All right. So first of all, they're talking about how bad everything is. And if you can see on the screen, let's pull it back up here. I mean, look at the market. It's fucking rebounded. It's only down like 7 points. So they're making all this doom and gloom. I don't know what the hell they're talking about. The market is moving up as we speak. Look, you can see it right there. We're breaking through levels. It's only down 6. What the hell are these people talking about, man? They're just trying to throw all this doom and gloom out, how the markets are getting destroyed. It's fucking only down 6, you idiots. God, all right, I'm going to jump back off the screen. These idiots.
Weakening in the labor market that the committee would adjust. Vice Chairman Governor Waller has said that. Is that the case? Or with a 4% PCE inflation rate, can you be cutting rates?
How collaborative was it when the chairman had to go into a news conference like today and he'd offered his personal views of the Economic Club of Chicago? Was it easy for him to get the rest of the committee to get behind him so he could put his own language in the statement?
Well, Jay Powell's very, very collaborative, and he had bilateral discussions with every member of the committee. We did distinguish between the FOMC statement, which is a committee document, and the press conference. The press conference, he reads an opening statement, but that's Jay Powell speaking as Jay Powell. So as I think we mentioned before, when you look at the opening statement or even the press conference, you want to count the times he says we in the committee versus I, and sometimes that balance goes up and down.
That's an important distinction. Yeah. Bob, before we go into this news conference, Chairman Powell will walk out in about a minute's time. You got a quick question for Mike McKee. What do you want to know?
Yeah, I'd ask him about Sell America. How do they define it? What are they watching to see if it actually happens?
Something a lot of investors are thinking about going into this one.
And one that he definitely will not answer. But this is really going to be one of the key questions to really gauge how much the bond market continues to be some sort of counterbalance to risk in markets.
At least bonds are rallying. Isn't that the good news this afternoon?
I guess so. I mean, I guess we could talk about why. We could talk about whether it's some sort of global recession that's being priced in if there's no trade discussion or whatever it might be. But yeah, for now, this is great.
I think we're beholden to 1600 Pennsylvania Avenue. Maybe we'll get a tweet within the conference.
We've already had a headline that's shaken up this market from the President of the United States, the President unwilling to lower tariffs to get China to the table. This is about framing the negotiations into the weekend, but it also frames the risk for this committee. The FOMC, facing down stagflationary risk, articulated in the statement this afternoon, which reads as follows: the committee, attentive to the risks to both sides of its dual mandate and judging that the risks of higher unemployment and higher inflation have risen, emphasizing the language, the communication that came from the Fed chair more recently at the Economic Club of Chicago, and clearly the committee getting behind him. March 19th was the last Federal Reserve meeting. April 2nd is so-called Liberation Day squeezed in between. A generational shift in trade policy, totally shaking up the outlook for this Federal Reserve.
Which makes it incredibly difficult for them to give actual forward-leading indicators at a time of such great uncertainty.
It is May 7th, and the chairman has stepped up. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and...
Oh. So is this up to date?
Mostly.
At my last job, we used this tool called Scribe for onboarding.
Scribe? What's that?
Oh, it's this tool that creates step-by-step guides while doing a task. Here, I'll show you. So I just do the process as I normally would, and see? Scribe automatically documents every step I take and adds screenshots.
Well, what if I need to make changes?
No problem, you can update. It's that easy.
Okay, everybody, we're using Scribe for everything from now on.
Try Scribe and replace outdated onboarding with smart documentation.
Has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after
Look at the market.
reviewing
Market's
economic
flat.
developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand
market
that our actions
is
affect
pumping.
communities,
Look at that.
families,
That
and businesses
market
across
was
the country.
down.
Everything
Bloomberg
we do is in
was
service to our
dogging
public
it,
mission.
and now the market's
We
up.
at the Fed will do everything we can
Right?
to achieve our maximum
Those
employment
idiots
and price
don't know
stability goals.
nothing.
Thank you. I look forward to your questions.
Here we go. Now it's going to get good, right?
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmerose of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling, with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for
I just put on Bitcoin.
What does that look
So that's
like?
Bitcoin,
Well, let me say,
right?
I mean,
Look at Bitcoin,
so
right?
let's
Bitcoin right
look
now.
back and see where we are. So
That's what we got. Bitcoin's up
go through
1.58 here on the 1 minute chart.
We've had, unemployment in the low
You go to
fours for more than a
XRP.
year. We've had inflation coming down into now in the mid to low twos.
XXRP,
we've had an economy
right?
growing at 2.5%.
XRP.
So that is.
Oh
that
shit,
is
there ain't
the
no volume
economy
there.
as
Let's
we
go back
see
to
it
Bitcoin.
now.
All right.
What looks likely,
Bitcoin,
given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do
Bitcoin's
see,
up
if the
1.59.
tariffs
I'm going to go
are
back to the
ultimately put in
S&P
place at those
500,
levels, which we don't know,
but you can see
then
Bitcoin.
we won't see further
there a little
progress
bit.
toward our goals. But we might see a delay in that. I think in the
S&P,
in our thinking, we would never
that's the
do
1
anything
minute
but
chart,
keep achieving those goals. But we would.
I'll
at
bring
least for the
Bitcoin
next,
back over here in a
let's
minute.
say year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned it at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. We're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. That's not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on
In
that,
the market, dude.
so then how does
It's starting to
President Trump
tank,
calling on you
dude.
personally, as well as the Federal
Damn
Reserve
you, pal!
to make rate cuts affect your
Son of a
decision
bitch.
today and affect your job
Tearing it up.
difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in the actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT. And, we're down a couple of trillion, but I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect. And those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited.
Selling your car to Carvana is easier than you think. In just seconds, we can give you a real offer good for 7 days.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any.
All right, I'm going to put up the charts really quick at the S&P 500. I'm about to take off, but let's kind of look at it really quick, talk about it. All right, let's kind of make it big here. Hang on a second here. Bam. All right, let's talk about it. Let me zoom in really quickly. So, Powell's speaking. S&P 500 is up 21 points? Shit. You know, you can see here, hang on, I'm gonna working its way back up. So this is a 1 minute chart. So anyway, rates are the same. He kept them the same. Market is popping. You know, Bloomberg came out and Bloomberg was fucking dogging everything. Everything's falling apart. Well, shit, it ain't falling apart. Fucking up 21. Market screaming. So we'll see what happens tomorrow. News events. Thanks for popping in. Big decision. I'm going to day trade tomorrow. So if you want to day trade with me, come to the channel, right? All right. I'm going to jet out of here. Peace.